Whew. So where's Devin? I seriously need some of those spray caffeine things, like really bad. Okay, he's not here anymore. Okay, so this is, I'm loving that Marvin came just before me, because what 500 startups are doing solves a lot of the problems in the investment space. They went and said, we're actually going to be close to the entrepreneurs. We're going to make lots of investments, and we're going to get tired, and we're going to sweat, and we're going to party hard, and we're going to be anything but like a normal VC. And they've pulled it off. I mean, we've had a few drinking sessions, and I can at least attest to the fact that they drink well. Okay. What's interesting is the problem with investors today, and I'm going to start a bit with, where is that thing? I'm going to start a bit with, okay, how does this? Okay, fantastic. So this is just a quick walkthrough. I've been in the emerging market space of startups since 2007. I founded my own startup. Of course, it went bust, but we did make some money. That first startup, we actually got a chance to pitch to Kleiner Perkins, which was pretty impressive because I founded this in Beirut. I don't think a Beirut startup had ever pitched to Kleiner Perkins at that point in time. Then I got really stressed from the fact that that startup didn't go very well, so I created a cookie company, okay? And I decided to start making cookies, and I got very good at it, but then I realized I don't want to retire at the age of 30 into a bakery. So I moved from that and co-organized the biggest Arab tech conference. And in this journey, I realized, oh my God, there is an actual startup ecosystem in emerging markets. We're talking Lebanon, we're talking Arab world, and then I started looking further than that, Mediterranean basin, Central Eastern Europe, Southeastern Europe, so on. And so I decided to create an accelerator sequence. And that accelerator went on to create a microfund. That microfund invested in startups, yada, yada. And I ended up in a very interesting place where I facilitated the creation of a sovereign fund, $400 million, that invests exclusively in startups in Lebanon. And I advise that fund on all early stage investments. Now, where's the interesting thing in all of this journey? It's that I started off as an entrepreneur, and then because of the lack of available funding in the Arab world, I had to learn how to raise money and how to raise money for other companies. And in that journey, I realized that there's a very interesting problem, and that is startups are basically put up on stage. They are rehearsed, dressed up. They are prepared, and then they go through a beauty pageant style kind of presentation where the investors sit up here and they look at them and they're like, yeah, I like that one, I don't like that one. And they end up looking something like this, okay? And so, honestly, this is not that unrealistic. I mean, okay, not really, but yeah, notice the disclaimer, I took care with that, but yeah. So you end up with a bunch of brilliant people who are begging investors, okay, to invest in them. And the investors are like, yeah, but you know, and if you move to this, or if you reincorporate here, and no, I don't like your team. Anyway, so you end up in a scenario where it is a beauty pageant. And when I realized that this was a beauty pageant, I realized that there's a bigger problem here, because who's watching the investors? I mean, we have the startups on stage. They're all dressed up, okay? What about the investors? Marvin just said it. He's like, most investors suck, okay? Who rates the investors? Who tells you this is a good investor? Who tells you this is a bad investor? And if you don't have access to good and or bad investors, okay, but you have access to one investor, what do you do about that? Honestly, you can't do much, because from what I've seen, most startups will take any money they can if there is no money. So, did you know that most investors, okay, are startups? Did you know that most investors, especially obviously outside of tier 1 investors, have never done it before? So they went around, some guy in consulting, management consulting, never did a thing in his life except explain to people how they should do their own thing. You know, it's like the life advisors that have the most screwed up lives, okay? And they're like, okay, so I'm a management consultant, and now I have all of these contacts. I'm going to create a fund. I'm going to get some LPs, and we're going to make this succeed. And what ends up happening is this. I'm not making this up, okay? See that 0 right there? Okay. This is the average VC fund return in the last 10 years. The 0 part, okay? So this is fantastic, and this is like Cambridge Associates. This is not my data. I got it from somewhere, but yeah, very, very interesting because VCs obviously either don't know what they're doing or there's something wrong, okay? And Marvin seems to agree with me, I think, so. There are a few exceptions, but yeah. So what's interesting is that when you look at this, you're like, okay, this doesn't make sense. So why are people giving money to VCs? Why are they still giving money to VCs? And that's where you end up with the very interesting story, which is the European Investment Fund or bank, I'm not sure which one it is, okay, has to invest 8 billion euros over the next 4 or 5 years, okay, in startups in Europe. And Jeremy, most of the Launch Hub, 11, so on, everybody gets their money from the European Investment Fund. And then you get the question, which is, how does the EIF measure their investment performance? And I asked that question based on how much they spent. So the answer is, well, you know, did we spend the 8 billion or not? Okay. And when you think about it, if they're putting 8 billion of subsidies into startups, does it really matter when the subsidies towards agriculture is more like 200 billion a year? Okay. Nobody cares about the 8 billion over 5 years to startups. So let's just spend them. So then I was like, let's dig a little deeper and see what actually performs. And over the last 15 years, the top performing funds have been the ones under $50 million, okay? And there may be a lot of variables involved here, but the most interesting, I would believe the most interesting variable is when they are small, they are more committed. They are more involved. And when that happens, you see that the $1 billion fund gives you returns that are the equivalent of something very, very low risk, okay? The 50 million can give you up to 3 times if you pick the right fund, which, you know, I'm helping 500 starts. They're in the 3 up here in the small, yeah, right, okay. So then I was like, okay, but, you know, if they do growth stage investments, they must be less risky, therefore they will be making more returns, yada, yada. And so I looked at even more data, Sandhill Economics. In the 3rd round, the risk is practically identical to the 1st round. Okay. I was blown away by this. So the guy who comes in early is taking the same risk as the person who's coming in the 3rd round. What that means is not that there's less risk or equal risk, but the risk type is changing. Okay. And most people don't understand that. When you're throwing $100 million at something, it's a different type of risk than when you're investing $100,000 because, you know, the idea looks like it has potential. So I could put all of these together and I started thinking about where is the opportunity. So, okay, we realized that there's this massive problem with the VC market. We looked at smaller funds as being the highest performing, and then we looked at the risk. The earlier the investment, the higher the return. So I looked at the early stage, which, as you can see here, is zoomed into. The early stage has a very interesting gap in it. You have the pre-seed and seed, okay, which there's tons of, and the EIF, most of the EIF money actually goes into pre-seed and seed, okay, up to 200,000 euros, other than the big money that goes into the Atomicos and so on. And then you have the early in growth, and in between, you have between the 200,000 to a million euros, dollars, pounds, whatever. There's this massive gap where everybody's sitting tight. We're all on the edge of our seat, and we're like, I met that guy. I think they're going to do well, but I'm just going to wait until they hit the metrics. Okay? And every investor loves to tell you, come back to me when you get these numbers. And I'm like, when I have these numbers, I'm not going to need you. Okay? What's the point of coming back to you when I have the numbers? No, seriously, it's depressing. It's like, Yeah. Anyway, so funding gap. There's a gap, there's an opportunity. So we went and said, let's bridge this valley of death, okay? How do you bridge a valley of death when it is obviously a problem that everybody's trying to avoid? The problem is in the fact that the valley of death has the startups in that space where you've just exited the dream, which is, I'm going to change the world, invest in me, and you have a product where someone can come and say, oh, this isn't very stable. Come back to me when I can put a truck on this. And so there's that gap where there's not enough data, okay, supposedly, that I can't make a good measure, and therefore I cannot make a good decision. And so we came and said, what if we could actually look at data, but without looking at it in the old-fashioned way? Okay, what's the average cost per user? What is your average revenue per user? What are your gross profits, your gross margins? I'm not looking at these metrics, because if I do look at these metrics, I end up in the early and growth stage. So what can I look at? And that's where it gets interesting. It gets interesting when you start realizing that the evolution of big data now allows us to predict to a certain extent, okay, or measure rather than predict, what is the risk profile of a startup. We're not talking about the success of a startup, but the chances of failure. And those are two very different things. So what is the chance of failure of this startup? And of course, that cannot be in isolation. It has to be compared to others. So let's say we're looking at 10,000 startups. Of these 10,000, this one startup, how does it compare? What is this risk profile vis-a-vis all of the others? And so we came up with an interesting algorithm that allows us to measure up to 75% of the risk. And then we said, okay, fuck, 75%. I can't go on gut, because gut only gets us so far. And most people who go on gut tend to hit a wall at some point in time. So what can we do to mitigate that last 25%? And this is something that my co-founder, Yulin Lee, was able to answer over a cup of coffee. And it was like, why doesn't anyone implement proper modern portfolio theory, okay, into the startup world? So we're like, okay, 75% of it is measured. What if we could mitigate the 25% by applying modern portfolio theory to mitigate that risk over diversification? And then you end up in this scenario where you have this beautiful gap that's bridged, and you are bridging it because you have a population of 1,000, let's say, of which you've selected 10 to 20, and these 10 to 20 startups, you measured them, you are continuously measuring them, and you have selected them in the same investment entity based on the diversity and the likelihood to mitigate that risk. So what do we end up with? We end up with what is called a multi-criteria decision risk and multi-criteria decision analysis risk model, which is, there's supposed to be a circle in there, but it doesn't show, which is very interesting because we've built a framework and we've collected expert data, and then we use that expert data and we pass through public data with that expert data through the framework, and then get the startups to feed in private data to allow us to build confidence in our parameters and variables. And by doing all of that, we've built a system that can learn. And that system not only allows you to make an assessment on that first investment, but allows incoming VCs to better measure the outcome of our investments. And so we become a very, very, very attractive proposition for a VC, because a VC comes and says, oh, what's your portfolio like? And we plug them in, we give them username and password, and they can see the portfolio as a living, breathing entity. And what does that mean? That means that we've actually created a new asset class. We've securitized startup investing. We've disrupted startup investing. We position ourselves in a space where there's a funding gap, $200,000 to $1,000 million. And we present ourselves as an alternative to VCs Not because VCs are not good, but because at this stage, VCs don't even want to get involved. And we do that by saying, we take a management fee. We don't take a management fee. We skip the whole 20 to 30% management fee that completely kills the performance of the fund. We take an upfront transaction fee that allows us to create this entity, which we call a startup index. And then we take a variable performance fee based on the risk profile of this index. And why are we at an advantage? Because we effectively are the reverse of what a VC does. We bring together the startups, select the top performing, monitor them, measure them, securitize them in a startup index, and now we take that product and get buy-in from our LPs. So the LPs are investing in a product, not in a proposal. VCs come to LPs are limited partners, and they say, we have an amazing team, give us money and we'll make returns based on these numbers that we've built based on assumptions, and it's all bullshit, but give us the money, and most of them don't do anything with that. We come and say, no, here are the startups. These are their profiles. This is their data. This is what they look like. This is how they compare to others. This is why we selected them, and this is how you're going to track them through all of the lifetime of their investment. All you have to do is buy this as you would buy any securitized product on the financial market from wealth management funds and so on and so forth. And so our upcoming startup indexes, and this is what's exciting about what we're doing, is we're targeting 2 markets as part of our jumping into this world. We're doing Central and Eastern Europe, which involves everybody in Bulgaria, and we're doing Middle East and North Africa. They're 2 very interesting markets because the funding gap is very, very, very obvious, okay? And we generally believe that these are the markets that can be diversified at this stage through this modern portfolio theory and through our data process to allow us to create these portfolios that we will get buy-ins on. And of course, once these are up and running this year, we plan on producing another 10 indices next year in new markets and evolve that into a living, breathing product. So that's what we do. This is Alice. We're trying to reinvent this whole space, okay? Some of you have these, blank stares on your faces, but what we're basically saying is, it's broken. Marvin said it's broken. Everybody else who's gotten up on stage who's not an investor has said it's broken, okay? We're saying we have a solution, and it's pretty interesting. So get in touch with me. We're already involved with a lot of the partners in Bulgaria, and if you have any questions, please let me know.
Let's go for a couple of questions, guys. Amazing stuff, man.
Thanks.
I wish you best of luck with it.
Sure.
Shout. I'll repeat it.
Okay, here we are. So how do you actually get the startups before you have the cash?
Okay, this is always the first question that comes up.
It's chicken egg. So
it's not chicken and egg at all. When you sign a term sheet with a startup, do you put a timeline on when you have to close the deal?
Sure.
Okay, that answers your question.
Yeah.
Някой говори, микрофона му е пуснат.
But as I understand it, you go with a portfolio of companies
No,
to
we go
the
with-
investors.
we
So
go
you
with-
raise for every startup from all LPs.
No, actually, we raise for the entire portfolio, okay? And the LPs that we have are people who are committed to investing, okay?
Okay.
But it's like making a capital call,
Yeah.
effectively. But instead of going and saying, oh, we want you to commit, but we want you to give us we were going to make the capital call when we need the money.
Yeah.
We do the capital call when we actually ask you to commit, okay? The commitment on participating in the portfolios comes from, one, our process in terms of our credibility and our data, And two, the fact that a lot of these industries have a ton of high net worth individuals that are looking for places to put their money and need to be able to put it in high yield products because there's no yield at the moment.
No, I understand that, but just from a timing perspective, I don't really get it. But maybe talk later. I don't want to bore everybody.
Yeah. Just a quick example. We did this. We did a pilot of this. We were able to close a $750,000 index in less than 2 months with completely never before touched investment high net worth individuals.
Okay, but how many companies are in this index?
In that index, there were only 5 companies. It was just a pilot.
It's pretty hard to like do these deals then in kind of in parallel, right?
I know. That's what the machine is there for. That's what our platform is there for.
Yeah, but you still need to do deals. Like, I mean, it's just the company signing up to it and then you do a deal.
That's the secret sauce.
So there is one question there. One question with the lady there. I think could be the last one because we are really running out of time. And what happened with our cinema? Can you close? Yeah, shut the lights, please. I like the
drama.
Yeah.
So the question is, you're trying to indexize completely the startup investing, but whenever we talk about startups, we always say that it's all about the people. So where do the people come in? Do they matter? And how exactly do you measure a team with quantitative measurement rather than, if you want, a gut feeling about looking at these guys and wondering whether they can make it or not? So where do the people come in? That's a big...
So I can kind of answer that with this interesting study that was published not too long ago about what is the profile of a successful entrepreneur. And I think 3 parameters were white, Anglo-Saxon, and studied at Stanford. Okay, and that increased the chances of success by like 10-fold or something like that. So I think we're getting to the age where you can quantify people. I know it's scary, but you can quantify whether this person is high risk, low risk, and so on. Is it a pure science? I don't think it is. Okay, will it become? Maybe. I think we are moving into this age where data can be processed in quantities that were previously unheard of, impossible to even imagine. And we can look at the nuances and see specific things happening before they happen. I'll give you an example. Our chief data scientist, who has over 12 years of experience in machine learning, has built, as part of one of his previous projects, a smartphone app, okay, that can predict the relapse of a bipolar patient, okay, which means that if you are bipolar and you are getting close to a relapse, which means I'm going to take off my clothes and go running down the street, okay, I'm not bipolar yet. This smartphone app can predict that, notify his guardian or physician or whatever, and they can be treated before it happens. And we're talking about something very complex here, like the workings of the inner brain and so on and so forth. So if we can do that today with a simple smartphone app using the CPU of a smartphone, imagine what we can do with machines sitting somewhere crunching massive tons of data. So I think there is a massive team element. Our algorithm surely takes that into consideration, and we measure the risk profile of the individuals and as a team.
Everything crazy.
A last quick one from the right corner.
But the thing is, we really don't have time, and I need to cut you off.
Just a quick one. Can you tell us about, are you going to offer this securitization in this index available to the public markets to be traded? Thank you.
Maybe in the next 3 to 5 years. The problem is that when you create a product like that, you can easily do over-the-counter stuff, but once you put it in a public market, it needs to be regulated, which is a much more complex product. But there's always over-the-counter stuff happening in all types of investment deals. So maybe. I really can't answer that at this stage.
And Samir is here, so we can talk more about it, right? Because everything disruptive, skeptic about it, there's a lot of questions, but at the end of the day, to make things better, we need to be also a bit optimistic.
Thanks.
So, thanks, Samir, it was a good talk.